We're going to be starting our webinar. We're going to be speaking about the potential in volatile markets. This is Andrew. My name is Andrew Abraham, and I want to teach you about trend following, and I want to be your trend following mentor. Before we start, what I'd like to do is I just want to make everyone aware on the website of trendfollowingmentor.com. You can come here. Let me just kind of move this here 1 second. And you can sign up, and there's a free 40-page, whoops, kind of hidden here a little bit, manual that you can get on trend following. As well as I'm going to be having a book coming out with Wiley Books called The Bible of Trend Following, which will be out in the fall, and I invite you to pick that book up. Here, let's start our presentation. Let me move this back to here if I may. So what is the idea? The idea is that there's a lot of volatility in the markets. The markets have been selling off, and the question is, how do we protect ourselves, or how do we make money? But before I start, one of the most important things I have to do is there's a disclosure that I want to make sure everyone's aware of, that trading of futures and options involves substantial risk of loss, no matter who's managing your money, and it's not suitable for all investors. Very importantly, that past performance is not necessarily indicative of future performance. And there's a risk in trading commodities, trading stocks, and you should carefully consider that this is something that is suitable for you. And as far as the full disclosure, it's actually on my website, trendfollowingmentor.com, and it also alludes to that there's hypotheticals, trades that have actually not happened in reality, and these hypothetical trades have severe limitations. So let's jump over to MetaStock. This is one of the, I like using MetaStock. It's very simple. It's very easy to use. 1 minute. I want to start with one of the main charts. That's great. I don't see it. 1 second. Let's do window, and here we go. Bingo. And here. What we're looking at is the S&P 500. Before we start, I want to talk about a little bit about trend following and really what is the essence here. The idea of trend following is this is not a get-rich-quick. This is not the Holy Grail. It doesn't exist. That there's numerous trades. Actually, the majority of the trades that you're going to put on when you trend follow actually don't work. But what the idea is, what I teach you with in my mentoring class, is to have a plan and to help you formulate your own plan. So there's no get-rich-quick here. This is not like you watch YouTube that you're going to quit your day job and day trade and become, you know, a zillionaire overnight, because that's not reality, and all that does is you're going to lose money. So the reality of trend following is you're going to have drawdowns, which is you're going to have periods that you're going to lose money. And the other reality is that there's going to be long periods that you don't make money. It's not retirement of box. You know, that's a reality. I don't want to, you know, make everything seem so black, because the thing is, I've been trend following since 1994, and I've been able to compound money over all of these long years. And the only reason I've been able to do it is by actually having a plan, following the plan. And really what this plan is telling you, or encompasses the idea of knowing what exactly to buy, how much exactly to buy or sell. I mean, the same is that you can make money on the short side. The other reality is getting out with a profit and getting out with a loss. We're not investors. We're traders. We look to compound our money over long periods of time, and we really want to make ourselves available for any situation. And in my case, I mean, I trade stocks and I do trade commodities, and there's always bear markets and there's always bull markets, and that's pretty much the essence of what I'm going to start expressing to you tonight, or actually this afternoon, in this video. The first point I want to make is, and I'm going to make this a little bit closer, when I'm saying volatility in the markets, one of the issues that I've been bringing up, and now I also invite everyone to just put your hands up. How many people have been reading my the blog, and actually read the blog about divergences in the market? I had put this out several weeks ago, and it kind of alluded to the sell-off that we're been having. And the reality is, I don't know the future. No one knows the future. All we can do is try to follow our plan and make low-risk bets and see what happens. And let me qualify what a low-risk bet is. A A low risk bet is where you're risking X% of your account size on any one trade. And hypothetically, let's say if you're trading a $100,000 account, I don't like risking more than 1% of my account size. So my maximum risk on any one trade is $1,000. What does that mean is that this trade, it doesn't have to work. I don't lose any sleep over it. I'm, let's say, comfortable by putting on this trade. I don't have any pressure or fear, which is pretty much what destroys many traders. But going back on the ideas, you want to risk a small amount on any one trade. But going back to the idea of where we are, one of the things I pointed out in my blog is that we were hitting new highs here going back in April, and we fell in May, the beginning of May. And I said, be careful that there's divergences. It's like a heads up. It's a warning sign that things could be turning. And we really went from, let's say, 14 in the 1420s to where right now we're almost at the point that I exit every long that I have in the stock market, and either I'm short or I'm out of the market. And we're almost at that point right now. What the idea is, very simple idea, very powerful idea, and I'll show it to you in a second how it worked in the past. If we take out a 200-day exponential moving average and I'm below it, I'm out of the market. There's nothing for me to think about. And the reality is, this is based on Dick Fabian, who has been around for, or his father's been around for decades, where he had the 39-week rule, that if you're below the 39 weeks, you're out of the market, you're above it, you want to be in the market. I'm going to tighten up the screen. You kind of see what I'm looking at. You had this amazing run from about December, which possibly is ending now. We'll see. Here, you would have exited. Here, it would have gotten chopped a little bit. But the reality is, look at how many of you remember this ugly market back in 2007 and 8. You would have missed all of this drawdown. This simple rule. March-ish, March of 2009, here, start to go back in. Got it, went in. It's very simple and very strong rule. So that's the first issue of, let's say, how to trade the volatility in the market. And again, I don't know what will be. I don't know. It's very simply, if I'm below this line, I don't want to be in the market. It's too dangerous for me. And I have a wife. I have 3 kids. I have 2 dogs. I like making money. I like compounding money. And I know that when I'm below this moving average, very simple rules, that my propensity to make money is greatly diminished from the long side. And the only thing I really want to be is possibly on the short side. And the reality is, it's a lot easier to make money coming from the long side as opposed to the short side. The short side, you have a lot of, these volatility, V spikes down and V spikes up, and it's pretty hard to trade. You make more money on the long side. So that's the one. This is the first chart I wanted to discuss. Let's go to some other charts. Okay, this is a good one. This also shows you that anything can happen. This stock was the strongest stocks going back where you would have been in the market here. You had a buy signal. It was one of the strongest stocks. It's called Liquidity Services. What they do is some kind of auction service, which in all reality, I don't really care what they do. One of the things I teach you in the course is how to identify the strongest stocks or the strongest commodity markets or currencies in order to try to take that low-risk bet. And again, when I say low-risk bet doesn't mean it has to work. A low-risk bet means that you're risking, if it's, to me, what I suggest is don't risk more than 1% of your account on a trade. And I teach you where to actually figure out this 1%. And actually we use 2 seatbelts or 2 stops to protect ourselves. But even in this negative volatility, up until today, which is ironic, almost like Murphy's Law, this stock called Liquidity Services, it went up from, you can see right here, from about $39 to a high of 66 and change. And then basic today, you would have been taken out. This is a trailing stop. I had written an article back in 1998 called Trend Rider, and this is exactly how this indicator works. And it keeps you in the trend when the trend is working, and it gets you out when there is the propensity that it's ending the trade. you never know exactly when a trade begins or when a trade ends, and I've already had that question. I see Paul has asked that question. How do you know when a trend starts? Well, let me tell you this, Paul. You don't. And anybody who tells you they do, they're not really telling you the truth. All you can try to do is you're trying to buy a breakout. This is how I trade. I basically use two ways. A breakout, which you can actually see right here, that this stock was one of the strongest stocks and it broke out. And then I just basically see what happens. If the trade works or it doesn't work, I say to myself, how much is it going to cost me to see what it's going to work? Because I don't I don't have to come with that assumption that it has to work, but I'm going to see if it does. And this case was, even in this volatile market, this share is extremely profitable up until today, as Murphy has it. It ends. This trade is over. This trade is exited with a profit. And that's the point also. You need to know when to exit with a profit and when to exit with a loss. There is no rocket science to all of this. I use very simple ideas because that's the only thing that can hold up in these volatile markets and these volatile times. And it's a whole plan, because imagine you try to start a business. If you try to start a business without a plan, you're probably not going to succeed. It's the exact same thing with trading. You actually do need a plan. Let's go jump to this next chart, because I want to save some time for some questions. I want to make myself available. I want to say this. The reason I'm doing this is my goal is to teach you and to help you to fulfill your goals. I trade for a living. I've been trading for a living since 1994. This is actually, it's, again, as I said before, it's not a get-rich-quick. It's a compound your way to wealth. The reality is you go through long periods that you don't make money. You go through periods that you do make a lot of money, and then you give some of it back. But it's like a marathon. You kind of grind it all out. So let's jump to another trade. Silver. I'm actually in silver. I've been short silver. Silver is popping up today, and I'm giving back a nice chunk of my profits, but took a nice trade. And the idea is, when I'm saying volatile markets, you come into the markets without any expectations. You let the markets tell you what it's going to do. And you're going to, as I teach you, to identify the strongest and to identify the weakest. And then the idea is, once you identify them, the idea is like, as if it's a conveyor belt. It goes through a conveyor belt of saying, can I do this? Can I do this? Can I do this? Can I do this? And at the end of it, you either take a trade or you're going to have to pass a trade. But silver was a trade that I'd taken. It was one of the weakest markets, and we'll see what happens. But again, you can go long or you can go short. Again, there is no reason you can't go either which direction. Let's jump to a next market. Okay, this is a good one. Gold shares, actually it's Newmont Mining, has been extremely weak. You can see actually it's been going short from about in here. I got in this trade in a retracement trade, and it looks like if I'm going to close above this line today, which it's really much pretty close to there, thank you, I'm out of this trade. And this is what the idea is. And my opinion means nothing. When you trade, you basically you put yourself at the mercies of the market with your plan. The market wants to go down, you try to sell it, and you see what happens. And you know, it's been a nice trade. And then it's exiting today. Looks like it's exiting. We'll see. You know, we have another couple more hours of this market. We'll see what happens. Again, anything can happen. You can make money going short, which I did here. It's a nice short. And you can also go going long like Liquidity Services, which that trade is ending. And you just got to keep on putting them on. The other thing I want to point out is you make your money over a long series of trades. You don't. This is not like you just get one trade and you know, and it just works and it's over and you make all kinds of money. That's not reality. The reality is you want to be consistent. You want to do the same thing over and over again with this, let's say, plan that I help you build that matches your personality. And the idea is, and I've had this with students, they say, wow, that's boring. And I'm like, well, what do you want to do? Do you want to make money or do you want excitement? If you want excitement, you're doing the wrong thing because you're going to lose money. I mean, you have to really analyze, why are you trading? For me, as I said before, my motivation is, I love this. This is my passion. Teaching is my passion. It's pretty cool. I meet people from all over the world. I'm looking at some of these people that are on this attendees, and I see people from Vietnam, South Africa, Canada, people all over the world, England, and you get to talk to them, and you try to help them. Because the idea is like this. People have asked me, why am I doing this? And the idea is, I've been helped. I've had mentors that have helped me along the way. The thing is, even with the mentors that have helped me, it wasn't that easy. It took me a long time to actually internalize what they were trying to teach me. And in a very brief of this, because again, it's kind of, they're hectic markets, and I want to focus on actual work that I have to do, and I also want to make myself available for some questions. But the idea is like this. In order to succeed in trend following, or let's say trading for a living, you know what? You have to stop looking for the Holy Grail. The Holy Grail doesn't exist. Realistically, the Holy Grail is coming up with a very simple, robust plan that trades all markets, all time frames, the same. Too many people, and myself included when I first started, were seeking this magical indicator or this magic system. Well, once I realized that it doesn't exist, I started making money. And that was really my motivation, was trying to become independent, to be consistent, and be able to support my family doing this. I had sold a business and was left with a chunk of money, didn't know what to do with the money, and I wanted to grow this money. And you know, these are the ideas that you take these ideas from me, you can expound upon them to fit your own personality, to basically get to the level of being financially independent. Let's jump to another two charts, and I want to make myself available for questions also. As another example, is the euro dollar, because there's all of these people out here that love trading Forex, which, and to clarify one thing with Forex. Forex is not a get-rich-quick. Most people lose money with Forex. I want to make another very, very strong statement. 90% of all people that invest and trade don't make money. And I call them the 90%ers. You have a choice of the 90%ers or the 10%ers. And really what I hope to do is hope to get you to the point of being the 10%ers. This was a trade, the euro dollar, not a magical trade. Basically, it was a breakout to the downside. Not that I watched the news and, you know, going on with Europe and all that kind of stuff. That had no bearing on this. The news never has bearing for me. I follow my methodology. And again, I want to reiterate that the majority of my trades don't work. And when I say they don't work, it means I lose money. But you have to really watch the wording. Everything is how you think. It's not that I make money or I lose money. Trades either work or they don't work. And I don't attach any significance to this. The worst scenario is when you don't follow your system and you make money. It's almost like a negative reinforcement. So the idea is that you follow your plan, and many times that plan gets you into trades that kind of shock you. I can pull up a cotton chart. Well, I don't want to get a little bit we're a little low on time already. But the idea is like this. Things go to extremes. Apple stock went to an extreme where it went to the prices that it went to. And really, it's going to an extreme now where people are in shock that it's selling off. I mean, people would never in their right mind think that Apple could sell off. Well, believe that anything can happen. When I have this euro-dollar trade and everyone's talking to go to parity, that almost makes me nervous that I shouldn't want to be in this trade. But the idea is I follow my system, I follow my methodology, I follow my plan, and then I let it work over time. I'm patient, I'm disciplined, and these are attributes that I want to instill in you and teach you. And, you know, it's easy to say be disciplined or be patient. In reality, I have a student in Australia who he's an engineer, and he got out of a trade. And I said, why did you exit? Because, you know, I asked the students to send me their charts. He said, I got bored. And this is not about being bored or excited or anything. If you want to succeed in trading and trend following, really what the key is to be consistent, follow the plan. There's no excitement here. And actually, the real truth is it's kind of boring. And boring is good. Okay, let me jump to the next chart that we got here. Hang on. What's that? Okay, this is a trade I've been in for a long time. And to be very honest with you, I know absolutely nothing about soy meal. I have no idea what it even looks like. What I do is I trade a basket of commodities, pretty big basket. And the idea is that I want to be available for anything that moves. And how I do that is I identify the strongest markets and the weakest markets, like I told you. And then I look to say, well, I'm willing to risk, actually in the two models in which I run money, or actually my proprietary account, excuse me, I look to risk 75 basis points on one model, which I don't want it to be too much volatility. And the other one, I'm saying, you know what, I'm not putting that much money into this account, and I want to get more of a bang for my buck, and I'm willing to risk 1.25%. So on this trade, I risked, actually it was in both accounts, and the trade just kind of worked. Not that I knew anything. That it, you know, and again, I want to really strongly reiterate, most trades that I put on don't work. And I take a lot of small losses. There's only 4 things that can happen. And I try to keep my losses small, but I can't control it because you can see that, like here, things gap. You can't control gaps. And sometimes they gap this way, and guess what? They can gap that way. And then also, in the futures market, you can have limit days where you can't exit. So as much as you think you can control your risk, all you're really doing is attempting to or trying to. And going back to the 4 possibilities, you have big losses as a potential, you have small losses as a potential, you have small profits as a potential, and then you have big profits as a potential. Let me give you the reality. I put my stops in the minute I'm filled, my stop is in the market. But again, that's still not a guarantee for me. As you can see here, this gap down, that's a pretty big gap. Gaps can happen. There's no way to prevent them. They happen in stocks and they happen in commodities. But the reality is, I put my stop in, it's out of my control, and I see what happens. So I try to avoid the big losses. And in most cases, I do. And there are cases that I can't, and I get hit. And that's reality. Then the next reality is, most of my trades don't work. I mean, here I am, I'm trying to teach you a methodology, and I'm telling you most of my trades don't work. But you know what? That's the reality. That's the truth of this. I mean, people that tell you they have these high win rates, it's not reality. Because nobody knows the future, and you don't have to have this high win rate to make money. Really what you have to do is catch a trend and then have the propensity to stay in the trend to compound money. So I have a lot of small losses. Conversely, I have probably a lot of small profits, which pretty much cancel each other. And as I said, as I attempt to negate these big losses. And then the other reality is, let's say out of in a year, and in my trading, I might put on 100, 120 trades in a year. I don't trade that often. I might only have a handful that really, really work well if I'm lucky. And the thing is, it doesn't depend on me. It depends on the markets. Like in 2010, I did really good. Had a great year. I didn't do anything different than in 2011, which I had a pretty pukey year. And that's what trading is. You just have to be consistent. But I also want to add the very important issue. I don't look at it, how did I do today? How did I do this week? How did I do this month? Or, shockingly, how did I do this year, excuse me. What I look at is how did I do over the last 10 years? And the only way I can say 10 years, or in my case, 18 years, is I believe in my methodology. I've tested it. I believe in the propensity of it. Because the idea is, if you can pull this off by trend following, I'm going to put a big if because we don't know the future. And again, past performance is not indicative of future performance. But you can go to a website called ISG, and you can see that there's a handful of commodity trading advisors that have been around for decades. I'm talking decades, from the 80s even, that have been able to pull out, on average, a compounded annual rate of return about 15%. That's over time. It doesn't mean every year 15% and a Madoff, don't worry, 1% or 1 and a something percent per month. That's not reality. It could be you make 10%, you could be down 8%, you could be up 25% the next year, but it's on average. And if you can pull out that 15% compounded annual rate of return over a 10-year period, you know, that's if the markets can give it to you, and we don't know what the markets will give us. That basically means you 4 times your money. And the next issue is, if you can pull this off, or I don't want to say you pull it off, basically we're fishing. We have a fishing rod, and if we're lucky enough to catch the fish, which are trends, then we stand the potential to compound money. And over 15 years, if you can compound it at 15% compounded annual rate of return, it means you 8 times your money. And again, I want to stipulate very, very strongly, this is not easy. That you're going to have ugly drawdowns in those periods of years. You're going to have drawdowns that you just don't think are ever going to end. You need to stick in the game. You need to be, it's like in a football game. You could be down, let's say the first quarter, first half, down the third quarter, but you know what? The football game is made by the end of the game, at the end of the fourth quarter. You got to stick in the game. It's the exact same thing with trend following. You get hit, you get knocked down, and you have to get back up. It's almost like, I have a book coming out, and it's called The Bible of Trend Following. And there's a very famous trend follower who did the foreword of my book, a guy named David Drews, who's been trading since the 1980s. And in the foreword of his book, and actually if you want, you can email me, and I'll send you the foreword. What he says, you know what trend following is? Getting knocked down and having the ability to get back up again. And then getting knocked down again and having the ability to get up again. And then even getting knocked down one more time. And the idea is, this is the reality. This is why so few people can succeed in trend following. And that's why I want to be your mentor. I want to be your coach. I want to teach you the methodology. It's not about indicators. It's not about systems. It's happening. Because what's going to happen to you, and it's happened to me, you're going to have not 3 trades, 4 trades, 5 trades, 8 trades, maybe 10 trades in a row, or 8 months in a row, or 10 months in a row. You don't make money. I don't care if you're trading stocks. I don't care if you're trading Forex. I've been there. I've done it. I can tell you this is the reality of it. I can tell you in 2005 and 6 was probably one of the worst periods ever for my trading. And my wife would tell me, do you think it's over? And I told her no. And what kept me going was my colleagues, that we were in the same boat. We were all getting beaten up, getting knocked down, get back up, put on the next trade. Take the next trade, put it on, see what happens. No, like, how many of you guys think, and I want to see a raise of hands, that basically, and raise your hands, that it's almost funny. If you get 5 trades in a row, do you quit? How many of you have the wherewithal to actually put on the next trade? And it's like what I say to myself, which is kind of funny. I say, how much is this going to cost me to see if this trade is going to work? And I have a colleague who came out of a very large family office where they were trading huge money, I mean in the billions of dollars. And we were talking about risk per trade, like I alluded to before, the 1%. And I love this analogy, and I want to share it with you guys. It's like bites out of the apple. The idea is like this. You only have so many bites out of the apple. And the more, let's say, the more risk per trade means less bites out of the apple. And with a 1% risk, guess what? You have 100 bites out of the apple until you have any more apple left. At a 2% risk per trade, you get 50 bites. 3% risk, you get 30 some odd bites. This is what it's all about, is trying to manage the risk and staying in this game of trend following, and to really understand where we're at and what we're trying to accomplish. And really what we're trying to accomplish is to compound money over long periods of time, stay in the game, not quit, and make ourselves available for any potentialities. And there's things that happen that just go beyond your wildest beliefs. Again, I want to open this up for some questions. I want to thank everyone for coming here. This isn't the Andy show, the Andy Abraham, just talk and no questions. My goal is to help you guys get to the point in which you want to, let's say, get to. And I know it's a struggle. I've been there. I'll tell you very honestly and very humbly, I probably made every mistake possible, and probably made them more than once until I actually internalized what I need to do. And I was lucky. I'll tell you this other story, and then we'll just do the questions, and then I have to wrap it up. One of my mentors was a dentist. It started in 1979. I have this actually on my website. And he doesn't know anything more than any of these other money managers. He started with $200,000 in 1979. And really what he did was very simple idea. It's a Richard Dawkins breakout approach. Not a lot of filters in the beginning, a lot of hand charts in the beginning. And he was able to compound that 200,000 up till today, where he's pulled out about $12 million and has about a $5 million account by compounding money. And again, it wasn't a get rich quick. It was a compound his way, and in his case, complain all the way that he had drawdowns and ugly drawdowns. When I'm saying ugly, I'm talking 30% drawdowns. Like I said, in 2005 and 6 for me personally, it was a 2-year period. I didn't make money. I had 30-some-odd% drawdowns. And the reality is, and I suggest you, if you don't want to take my word for it, let me just pull this up. It's ISAG. You can sign on to their site. It's free. Oops, 1 second, bear with me. And you can look at some of these managers that have been around for decades. And the fact is, I don't care which one of them, they've gone through some ugly drawdowns. Well, I don't know why it's not going so quickly. Hang on 1 second. Hopefully we're opening. Going slow, even though I'm on cable. Maybe because of the webinar. Anyway, this is the site, ISAG. I invite you to go to that site. It's for managed futures. Here, let me just jump to it. I want to show you something real quick. 1 second. Hopefully this will open very quickly. Okay. This is a manager who's been around since 1988, Salim Abraham. What I want to point out to you, and again, the reality, and this is a gentleman who's been trading, hopefully this will open in a second, since 1988. I've invested with him. Has a compounded annual rate of return, right here, 18.32%. But he's had 31 points drawdown. That's almost a 32% drawdown, and he's managing almost $500 million. You can see he's been around since January of 1988. The fact is, these aren't wishful thinking. Salim Abraham's a great trader. He doesn't know anything more than you. He's not, there's a handful of these guys out there. Again, I'm not telling you to invest with him, but I'm just trying to give you the point that it's doable and that it's possible. And, do your own homework, and you can actually see managers and their compounded annual rate of returns, what they've made and what their drawdowns have been. But it is doable. It is possible. I want to jump back to questions. I want to make myself available real quick for some questions, and then we need to wrap this up. And then again, I invite you all. You can email me. It's Andrew@trendfollowingmentor.com. And again, I invite you to download the 40-page manual that I have on trend following. And the reality is I have a book coming out in the fall called The Bible of Trend Following with Wiley Books. I invite you to read the book. I'm sure it'll help you. Okay. Oh, here we go. This is the second time I got this question from Paul. How do you know when a trend really starts? I thought I answered it, but the reality is you don't. You never know when a trend starts. All you can say is when it really ends. And I use very simple indicators as part of my plan, and I teach you these. I mean, you can read an article, and you can email me, and I'll send you the article. It was written in 1998 called Trend Rider, which is based on a volatility type of ATR trailing stop. Not rocket science. Again, it's not the issue that's going to make you succeed or fail. It's just part of the puzzle. So in reality, you never know when a trend really starts. You only know is when it ends is when it hits your protective stop. Okay, next question is, okay, Gary, how do you know when to exit? Well, I just kind of said that. I use a volatility based stop, and what happens is if I go below that stop or I touch that stop, there's nothing to think about. Let me just go back to this chart that we talked about, this Liquidity Services. This would have exited. It hit the stop dramatically. This stock today is unbelievable, where intraday this thing went from almost like a, well, almost a $9, $10 range. And this trade is over. It took out my stop and over. Nothing to think about. Thank you. Gone. Goodbye. Okay. I have from Rajesh. I usually buy 100 shares at a time, and I've read your blog, and I don't understand what is position sizing. Okay. Position sizing means it all goes down to your risk per trade. When I talked about I don't like making a risk more than 1%, the idea being that for the same 1% risk, I can put on more shares or more contracts. That's kind of what is the idea of position sizing. The whole concept is called fixed fractional, and I can get more into it when basically during my teaching. But again, you look at your risk, you figure out where your entry, where your stop is. You look at your, let's say, again, you get to decide what that risk is. To me, I don't want to supersede more than 1%. And how many shares or contracts can you actually put on for that 1% risk? Okay, this is another question. This is, here I got Vivian. How do you know what to buy? What you look to do is you look to buy the strongest, you look to sell the weakest without any opinions, without any news, without anything. And the way it works is really simple. It's a smooth rate of change, and you average it over several periods, and you can actually do it in, I have an indicator here in actually Metastock that is called ranking, and it ranks. And the idea is you delineate the strongest, you delineate the weakest, and it tells you really where you should focus your energies on. That is really the idea of what we really try to teach. I mean, it's a whole package. What you want to know is what to buy or what to sell. You need to know how much to buy or how much to sell. Then you need to know, and once that happens, you got to say to yourself, I have the discipline and the patience to let it work, and say to yourself, how much is it going to cost me to see if it's going to work? And you basically sit back and see what happens. This is what I try. I mean, I made it very simplistic. It's a little, we go through a lot more filters. But again, it's simple, it's robust. But the issue, the difference is what makes the, let's say, the men and the boys or the women from the girls is having the propensity to get back up, as David Drew said. When you get knocked down, and I promise you, you will get knocked down. I want to be here to help you get back up and keep you in this game of trend following. I want to thank everyone for coming this afternoon. It's hectic trading. Again, the fact is, we don't sit behind the screen, and I don't really, well, the truth is, I don't sit and watch the screen all day. I'm up at 5 o'clock in the morning, my orders are in the market, I'm done. But I'm talking to other traders, I'm talking to potential students, I'm basically available. But the idea is you don't have to sit in front of a screen and watch every single tick unless you want to be almost somewhat of a masochist with being a day trader, which, hey, people make money day trading, people make money position trading, and it all has to match your personality. Again, I thank everyone for coming. And again, thank you again. And I'm going to happily, oops, I want to stop the recording. And again, I want to thank everyone for coming. I invite you to, if you have questions, please come, and you can email me, you can call me, we can schedule a time to talk. I'm here to help you and to get to your goals. Thank you very, very much.